Okay, so we are live now. So good everyone. Good to have you guys for this session. If you are just joining in, you can just let us know your name, your startup name, and your location. So founders joining in, just tell us your location and what you do and your name, so that we know we have founders here. So while we are waiting for the introduction from founders. Let's quickly introduce the speakers we have here today. Okay, we can see a lot of people are joining. Please, your name, your startup name, and your location. Founders, we are waiting. Name, startup name, location. Okay, so while we are waiting for founders to introduce themselves, so let's move to the introduction of the speakers we have today. So today we have three speakers who will be joining us. The third speaker is yet to join. So let's introduce the two that we already have here. So we have with us here Mr. Caleb Ekubiri. Hope I got the name Caleb Ekubiri.
Yes, fair enough.
So Caleb is a legal and compliance professional with experience across financial services, entertainment, and corporate governance. He has expertise in regulatory compliance, corporate legal frameworks, and cross-border transactions. He has led the development of internal policies, risk-based compliance strategies, and control systems for startups. His experience extends to digital asset compliance, including travel rule implementation, virtual asset risk assessment, and governance for blockchain-based products. At Mossack Legal, he supports organizations in integrating compliance into operations and strategy. Good to have you here, Caleb.
Thank you. It's a pleasure being here. Thank you.
Okay, so we also have Mr. Oladimeji Kuforiji. Oladimeji is a tech investment and startup lawyer, business consultant, and thought leader with deep experience advising startups, founders, investors, and creatives across Africa and global markets. He's the founder of Law Savvy NG, a boutique law firm providing strategic, legal, and commercial advisory to early stage and growth stage companies. Oladimeji has advised and supported multiple technology-driven businesses across cybersecurity, fintech, proptech, logistics, and digital infrastructure. In addition to his legal service, Oladimeji serves in senior advisory and compliance roles within the startup ecosystem and is passionate about simplifying complex legal concepts for founders, investors, and emerging entrepreneurs. Good to have you here, Oladimeji.
Thank you, Pastor.
Yeah, so let's start with Oladimeji. What are your expectations for this session? What do you expect founders to take away from this session?
Well, all right. Thank you for having me once again. I think my expectation is to have founders actually understand that when they hear of compliance, they should not just think of paperwork, right? from the investor's perspective, I want them to understand that compliance is actually a risk management thing on the investor's perspective. So their takeaway should be how to manage their risk, for the investors internally and externally. So we'll be looking at compliance both internally and externally, and we hope we can simplify it for them as they build.
Thank you very much, Oladimeji. So compliance is a risk management strategy. So it's not just about the paperwork. So over to you, Caleb. What are your expectations? What do you expect startups to take away from this particular
Uh,
conversation?
all right, thank you, Pascal. So I would expect that after this session, that startup founders can see regulatory compliance as not a burden but a strategic advantage. Because sometimes, in my experience working with founders, at first instance, they just feel like, this is something burdensome, extra cost and whatever. But then I just hope that at the end of this session, they get to see it not as a burden, but as something that can propel their business to greater heights. Just like Mr. Oladimeji said, it's not it's risk based. You have to analyze risk involved to ensure that you stay. So I hope that after this session, they get to see it not as a burden, but as something strategic that can propel their business to the next level. Thank you.
Thank you very much, Caleb. So Caleb has also mentioned that founders should see compliance as something strategic that will help push their business to the next level. So, talking about compliance gap, Oladimeji, what are the specific compliance gaps? Or let me rephrase the question: what specific compliance gaps most commonly cause global seed investors to walk away from African startups?
Okay. Um, so as I said, when we think of compliance, so compliance are in two phases. So we have the internal compliance that deals with things around your internal structure, things around your cap table, your founders agreement, intellectual property, discipline in the company, and the external things around licensing. Do you actually have the license to operate whatever you're doing? Data protection, all those rules and regulations that pertain to your sector. So most of the times, investors don't, walk away. They are not afraid of the African market, really. They are just afraid of the structural uncertainties. So there's the gaps that causes investors to walk away are one in the internal space, unclear cap table or undocumented equity. So we are talking about the internal compliance now. So when because an investor is will be joining your cap table. So if there are existing investors, so-called on the cap table, I need to know, are they founders or are they people that have actually contributed in terms of money to the company? So I need to know who I'm joining. So these are one of the things. Um, Intellectual property. Investors want to know, have you taken care of things internally? Who owns your IPs? Because I've had the privilege to work in the venture capital space, and there was a particular transaction that during due diligence, we found out that the founder used to be an employee in another competing sector. And there is actually an existing lawsuit that the employer was actually suing one of the founder, that there has been that he literally took the intellectual property of the former employer to start his own business. So these are key things, right? And also there are situations where a company would be hiring a developer, outsourcing a developer to build a product, and there have not been any intellectual property assignment agreement. So things like this are red flags. Investors want to see that do you actually own the IP to your product? And agreement also, these are also gaps, right? Are the founders, are there agreement to actually solidify the relationship? And when we now look externally, do you have the relevant license to operate? Because investors don't want to put money into a company that eventually they will now use that money to pay fines, right? So these are things, these are gaps that investors notice, and they just say, "Oh, we can't continue with this deal."
Okay, thank you very much, Oladimeji, for that. So, over to you, Mr. Caleb. I don't know whether you have any additions to what he has said concerning specific compliance gaps. Most commonly,
Okay,
yeah,
so he has pretty much hit the nail on the head with regarding cap table. Before I believe before you go for seed rounds, definitely you must have had some kind of funding to kickstart. Probably you raised money by yourself, or you had a few friends who believed in your vision that came around and put money, right? And you promise them some kind of ownership in the company. So if these are not well documented, or if this is not well itemized or broken down in a way to consider future investments from like VC companies, that may end up causing some kind of trouble or delays to getting the seed round funding, right? IP very important, like I mentioned earlier, IP is like the new, will I say, crude oil in the technological space because everything you do in this modern age depends on your intellectual property, the products of the mind. So if there is no proper assignment, because you have people working with you, if there is no proper assignment as in intellectual property, vesting the ownership of that IP to the company, it becomes a problem. So these are some of the things that could discourage, investors. Another thing too, like you mentioned, you need to operate with certain licenses for the kind of industry you are operating. Let's say you're in the food space. For instance, in Nigeria, you need to get license from NAFDAC. You're in the banking space, you need to get license from CBN, SEC, and other relevant regulatory bodies. If those things are not in place, it can serve as like a problem when it comes to seed round funding. Another thing is that another factor too may be, considering the fact that some of your investors might be foreign investors or most likely foreign investors from, let's say, countries in the US and the EU, right? So if there is no solid structure as to how, let's say, offshore, one thing we see common now, I notice in the Nigerian startup space is that sometimes I go through some startups and I see that okay, they are registered with their primary address in somewhere like Canada or US or UK, right? So it's not about just registering your businesses offshore in like the US, Delaware, registering in Canada or registering your office in the UK. Is the structure for that offshore corporate governance in place? Is it well arranged? Right? If the structure is faulty and shaky, it may signify a red flag to the investors that they may be skeptical about joining in unless every compliance regarding that offshore structuring has been sorted. I've worked with a client before who they inquire, okay, what does it take to register my business in the US? Like having a holding company in the US and then that of Nigeria serving as a subsidiary company. We see that these are all done in the aspect to attract international investors. So if these things are not well ironed out, they end up becoming a problem. I think that's what I have to contribute with regards to that.
yeah. Thank you very much, Caleb. So you spoke a little bit about registering offshore and having your base offshore. So let's move towards that direction a bit. What governance structures do you think should be established before raising capital offshore? Caleb.
Okay, so first off, like I mentioned, we see this every day in practice, whereby modern day founders, let me use that word, modern day founders, there's this need or desire to, have their company registered offshore, like the most common, would I say the common way or the most easiest way that is easily attractive to startup founders today is registering their company in like Delaware in the US, which is because it's quite seamless compared to registering in other states in the US. So it's quite startup founder friendly. Let me use that phrase, right? Or registering in other places like Canada and the rest. So, but what we have to consider when it comes to you know governance structure that should be set in place before raising international capital, right? You need to understand that this is the business, and obviously there are going to be founders, right? So if you are going to consider raising international capital, there must be a plan for how the equity is going to be shared, right? Because you cannot expect to still own 100% of the equity in the company while trying to attract international investors. And so there are ways whereby funding can be structured that does not require giving up equity. But for the most part, we see that equity is involved. So one thing that has to be taken care of, right, is making sure that there is no debt equity or equity risk in the future. And that has to do with founder vesting, for instance. So we see where, let's say, for instance, you see four friends come together to start a company, and then um, they all share the what they call it, the shares among themselves. So there will come a point in time whereby they might have to divest those shares, right? They might have to divest those shares to the funding company, so to say the VC. So there should be one of the governance structures that should be stated, like Oladime you mentioned. There should be like a founders agreement that will clearly state how equity will be vested among the founders to show that there is not going to be a one size fits all sharing equity sharing throughout the entire process. Right? When there is founder vesting, showing that this shares is going to be vested for a certain period or a certain period of time, it's going to enable the founders to put in the work that is necessary to push the business forward. Because if the equity is not vested, you know, right, anybody can decide to leave at any point because they are assured that whether they are there or not, their shares still remains with them. But if there is founder vesting, right, it reduces the exit risk of founders. So founders will not be prone to just leave the business at any point in time. After all, I still have equity in the company. You can't do anything about it. But setting up founder vesting, for equity is going to help, make sure that international investors are more attracted towards that. Also, um, the governing body or the governing board of such company. Some people just feel like, oh, it's just to register the company and then we are doing business. No, the board structure, the decision making body must be well mapped out. The timeline for decision making, the quorum that needs to be formed for any board decision needs to be itemized and arranged. If there is no proper structure that shows how decisions are being made in the affairs of the company, it already sends a red flag to the investors that, oh, these people don't have the house put together, right? So in order to be able to attract investors, we need to make sure that the board structure is in place. So it's not enough to just have the business going, but there needs to be a proper board structure. Another thing, like we rightly mentioned, is the shareholders agreement, right? So there needs to be a detailed outline on how the shares in the company are going to be handled. For instance, we know it is common in private owned companies that before you um, concede to selling out your shares to an external person, you must first of all offer it in house to see if there's going to be like a buyback by either the company or by fellow shareholders. So these are some of the items that the shareholders agreement can be able to help, you know, straighten out. And if these documentations that are necessary to show that okay, this company has good governance structure, they have good board structure, they have proper founder vesting, they have proper shareholders structure on how things are done around shares. That will be able to give the investor some form of confidence that okay, we are walking into a place that is low risk. There is no business that is zero risk. We have to get that out there. At least they will be more interested when there is no risk because, like you mentioned, like Valeria mentioned, compliance is about managing your risk. So if these governance structures are set in place, I think it will be able to attract international investors more because international investors, like Oladime rightly said, they are not afraid of the African markets. They are just, being cautious with the risk involved in it. So if these are all set in place, I think they will be able to attract international investors. Thank you.
Thank you very much, Caleb. So, Oladimeji, I don't know whether you have some additions to governance structure that need to be set before raising international capital.
Yeah, I think he has pretty much mentioned the key areas, but let me just so in practical terms, another things that is usually necessary is so where there is a US entity, for example, so there will most likely be the Nigerian entity. So there is always the need to tie both together. So we call it a Delaware flip or whatever flip you want to call it. So what happens here is you are because what the startup has actually done is to say, oh, our parent company is in is in Delaware. So what is necessary for that structuring to be solidified is to do what is called the Delaware flip. And what that is you need to make the Delaware entity the
Parent company.
majority shareholder in the Nigerian entity. So um, in practice, now in Nigeria, you would need to increase your share capital to 100 million, and so when you increase the 100 million, because that's now the requirement, it used to be 10 million before. Most founders are still making this mistake. They think it's still 10 million. So well, now it's
Yeah.
100 million. And no, you don't need to have that 100 million. That 100 million just affects how much you'll be paying to increase the shares. So you don't need to have the 100 million in your bank account, except you are applying for some licenses with CBN where they would require the proof of the
Funds.
capital. But when
Yeah.
you are in some certain industry that doesn't require those very stringent license, CBN, SEC, you don't need to have your 100 million. So once you increase the share capital to 100 million, the Delaware entity can now be the so you can make it the only owned, or maybe some would do 90 10%, some would do 99 1%. But as long as the Delaware entity owns majority shares, that means you've established the structure. Another thing you need to do is to register with NIPC, that's Nigerian Investment Promotion Commission, because the assumption when you have a foreign shareholder in your um, shareholder register is that there is a foreign investment coming in. So you need to register with the Nigerian Investment Promotion Commission (NIPC). So these are things that usually stall investment. There are some investors that will not proceed unless those things are in place. And as Caleb rightly mentioned, having your board structure and everything is very, very important. Some investors would say we cannot proceed unless there is a proof that you actually have a board structure. And when we say board structure, it doesn't have to be something complex. So what, as a startup founder, what you just need to do is approach people that are competent, in that industry, right? So you are just putting together a team of trusted and knowledgeable people that can advise you as you grow. So apart from the directors of the company, which are pretty much you guys, so you need to have other people, right? And if you have existing shareholders, there are situations where you can have those shareholders nominate, a board member, basically just having a solid team of experts that can advise you. So when you present all those things to investors that okay, we are not just working alone, we have people here that are knowledgeable in this space that can advise us as we grow. Those are things that build investors' confidence. So I think that's pretty much from me. Yeah.
Yeah, thank you very much, Oladmeji, for adding more insights to what Caleb shared earlier. So I think let's start from you, Oladmeji. So while Caleb was speaking, he mentioned a few more things about founders agreement and vesting schedule. How important are founders agreements and vesting schedules?
Very, very important. So what the vesting schedule what it puts in place is, so we have two, three people. So he's saying, all right, we are building this together, but at this stage, even while we are bootstrapping, everybody's contribution, it is coming over time. It is coming over time. So let's say four found, okay, four is too much. Let's use maybe three or two. So we are splitting in 50-50. We are splitting the equity 50-50. So you don't just get the 50% immediately. So the standard vesting schedule is a 4 year and 1 year cliff. So and a cliff period is the period where it not invest. So some can decide to put the cliff period at the beginning or at the end, but standard is usually at the beginning. So for the first 1 year, not invest. We have to do the work,
Put in the
right?
work.
So from year one, so that's like a commitment period that okay, I think you are serious with this. So from at the ending of year one, a portion, so let's say we are doing 50%, so that is 50% divided by 4. So that's 50 divided by 4.
12.5.
So that means on year one you're only getting 12.5, year two another 12.5. So what this puts in place is, because people have mood swing. Somebody can get to year two now, and maybe there is one rich uncle coming from somewhere and say, "Oh, this is your idea, and why don't we just let me put in money and let's build it on your own? Why are you doing it with someone else?" Right? Or
Mm.
the interest just changed. 2 years later, there is a new buzz of one advanced AI in town, and oh, this is the new oil. Let me pivot into this. I can no longer put in my energy and time on this. Where there is no founders agreement that contains a vesting schedule, what that means is when the person is leaving with the 50%. And that's a very big red flag for investors, because investors don't want to see someone on the cap table that is not contributing anything. So when there is a vesting schedule, when you are leaving, you are only leaving with the portion of your shares that has vested. So if you've only stayed for 1 year, you only get the 12.5%. And there is also another thing that we lawyers like to put in the founders agreement. So there is the leavers clause, right? A good leaver, bad leaver. So if you are living on a good note, your portion, you only get the portion of your shares that has vested. But when you are living on a bad note, let's say you've committed some very gross misconduct, you've committed something that has affected the reputation of the company, or within that small space of 1 2 years you've diverted funds, taking the small investors fund, you've gone to Mauritius, you've taken your wife and you've enjoyed life, and things like this are spotted, right? So that means whatever portion of shares that are vested is forfeited. So it's very important to have all the is one is very important to have the founders agreement in place, and the founders agreement should be well drafted to contain all these clauses. And another thing a founders agreement would contain is a non-compete clause, right? So I
Mm.
made an example of maybe a rich uncle funding the founder to start a similar business. Where there is a founders agreement that contains a non-compete clause, right? We would have put in a period in which you cannot, so it can be a limited period or it can be in perpetuity. But in fairness,
Yeah.
people will most likely just do maybe a 2 year or 5 year period that okay, you cannot, start another business that is in direct competition with the business. So a founders agreement will contain such non-compete clause. The founders agreement would also contain the responsibilities, who is doing what. Let's say the founders are, what's it called, a CEO and a CTO. So as the CEO, I'm following up with funding, I'm chasing investors. As the CTO, you just make sure the product is ready. Don't disturb yourself about looking for investor. That is, so the founders agreement would set up that rule. Another thing, so vesting can be in two types. We can vest per milestones, and we can also vest per time. So the first one I explained is per time, when we have the 4 year, 1 year cliff. So founders can also decide that, oh, okay, let's use vesting per milestones. So per milestone is, for example, a CTO, if you are able to finish the product, we've completed the MVP and everything, we are live. So instead of having a quarter of your shares to vest, we can both decide that okay, 50% of your shares will vest. So instead of 12.5, you get 25% immediately. So there can be milestone vesting. So usually those are ways to just put those balance in the agreement. If there are any other thing, I think Caleb can just impute here. Thank you.
Okay, thank you very much for that. So I don't know whether you have any additions, Caleb.
He's pretty much itemized everything, right? He pretty much said everything in regards to that. So um like he rightly said, these are things that needs to be in place, particularly when it comes to vesting, to ensure that everyone is at work. Because some people may just, I mean, you hear that, oh, there's a breakup in, in this company because the founders are at loggerheads and they went their separate ways. Probably over some little misunderstanding of certain things. But if there's a proper founders agreement that describes each person's obligation, stating what they ought to do, and also, stating the limitations of what they can leave the company with, for instance, with regards to equity, right? Because if I know, for instance, let's say someone knows that no matter what happens, this amount of shares is with them, whether they leave the company or not, they can decide to, just not do anything. At the end of the day, the shares already with them. They can decide to leave the company, they still own the share. But if there is vetting of shares, like you mentioned, either timeline or per milestone, right? Everybody will get to work. You state out, okay, this is what you're supposed to do. Everybody focus on your part. So you will see that that agreement will now help to itemize and enable each person focus on their directive. The CTO will focus on building the products. The CEO will focus on funding. The CEO will focus on the operations of the company to ensure that everything works in harmony and there is no, dissipation of efforts, but an aligned focus. So if that is properly done, I think these are one of the drivers to securing that funding from the VCs or companies at any level, both locally and internationally. So yeah, so that's pretty much it.
Okay, thank you very much, Caleb. I think we have a question here. At what stage of the startup should a founders agreement be drafted? Do you want to handle that, Caleb?
Okay, so like I would say, as soon as possible, as soon as possible. If you've not done one already, right, it's not too late to start, but it is advisable that from the get go, right, it's not enough to just have an idea from the moment of conception, right. That's why legal expertise is required. In as much as you are building a product that is going to serve the needs of your customers and everything, right, there is also the legal aspects to running the business, right? The legal and the compliance aspect to it. As as soon as you're starting to get incorporated, it's as important that you consult a legal professional who has expertise in such areas to give you proper advice. Because one thing I see some people do is some founders do is they just start the whole process and keep building. And when things are now beginning to gain traction, they now start thinking of things they should have done from the start, which is not bad at the end of the day. But the advice I would give is as soon as possible, as early as possible, get that out of the way. Because when you are in too deep, right, the risk is now higher, stakes are now higher. It may not now be so easy to get certain agreements penned down, and that may now start raising conflict. But if all these things are stated from the beginning, now, okay, this is how we are moving, this is what we are operating. But imagine you're starting a business and the business is not getting traction, and you are now close to getting like seed funding. And you don't start talking about shares vesting. They will be laughing like, but we have already come this way. Why you now start saying that, oh, that instead of me getting all the shares that I've worked with at this point, once I now start dissipating the shares and all that, it may now bring some level of conflict in the middle of the program, right? But if it's ironed out from the get-go, right, it makes things easier. At least there is an understanding from the onset that okay, this is how we are moving, this is how we are operating, this is the modus we are working with. So the advice to getting the founders and shareholders agreements is from the get-go, from the very beginning. And if you haven't done so, it is not too late to iron out those terms because now you are not. If you have international funding in view, it is important that you get that sorted out because
Mm.
if you don't, it will serve as a red flag to the international investors. Because I can promise you that international investors are very thorough when it comes to due diligence. They don't mind taking their time to make sure that every single documentation is accurate, that the T's are crossed, the I's are dotted. They don't mind taking. They are not in a hurry to invest, right? Even in as much as they see the potential, they don't mind backing out of a deal if there is a legal risk. So it is better that you sort those things out before approaching the investors, and that would also give you leverage because when you're approaching an investor and they see that your documentation are in place, when it now comes to valuation, right, they will not now dumb down what your company is supposedly valued at. Because if an investor comes in and they see a risk, that risk factor would reduce the valuation because in their mind they'll be considering this is a legal risk. There might be fiscal implications to this risk, right? Because money is going to be expended to cover this regulatory compliance and whatever. So if they notice that some certain things are not in place when you're approaching them, that can now reduce, the value you would have ordinarily gotten if these documentations were in place. So the advice is as soon as possible, particularly before you approach international investors. So yeah, that's my answer to that question.
Okay, thank you very much, Caleb. And we have another question here. I think for you, you mentioned about incorporating in Delaware. So, what are the required documents and costs for incorporating in
Okay.
Delaware?
If I speak the mind of Oladimeji, I think this is not a question for general answer. You have to book a consultation to get such detailed answers because this is a service where that is going to be rendered to you. So you can't just get that advice for free, right? So to do that, I think you need to book a consultation session, right, to be able to get detailed information on this. But it is nothing out of the ordinary, I would say. But for you to get such detailed answers, I mean, come on, let's do the proper thing. Let's do the proper thing. But it's something
Okay.
that can be done, I can assure you. Thank you.
Okay, so the person that asked the question, you can reach out to them to ask about that. Okay, I think let's finish up on our conversations before we take another question. So, how critical is data protection compliance for US and EU investors? Oladme, do you want to go first?
Yeah. So for US and EU's, well, in all honesty, so if we are looking at the level of risk, it is not high, right? We can just put it as a medium. And Well, and that actually depends on the industry. So that depends on the industry. So when you are maybe okay, let's just go to the affected industry. So if you are in the fintech space, you're in the fintech space, you're doing cross-border transaction, right? So during the due diligence stage, so there are different documents you need to submit. So you have the your operational document, your regulatory document, and everything. So they are expecting you to have at least from the minimum your data protection policy, right? Um, and so, as I said, depending on the industry, if you are heavy on your data, on getting data, controlling or processing data, so the investors would expect you to one, you must have registered with the NDPC. And here is the thing: so for most global investors, right, they would actually engage a Nigerian lawyer for most of this process. And trust me, the lawyers will do their work to identify those red flags, right? So, at least from the minimum, register with the NDPC as a data controller and data processor. There is a certificate that they would issue with that. And most recently, I think the NDPC issued a guideline, that you should have your data protection officer and everything. So those things need to be put in place. You have your data protection officer, and that data protection officer must actually be certified. That's another requirement now. And if you are um, in an industry that you've actually been around for a while, they would also require you to have your data audit. So there must be like a proof of you that you've carried out the data audit. And also, if you are in any of the sector that requires license from the CBN, right? In fact, maybe there is a sector that you actually have a CBN license. Let's look at maybe some payment service, maybe like a super agent. Let's not even go higher to maybe a microfinance bank, maybe a PSP, a PTSP. You hold a PTSP license. So before you even do any of your renewal or all those things, they won't even give you a renewal when you've not complied with all those data things. And when you've not complied and you don't have a renewal, it's going to affect whatever discussion you have with the investor. So I would, on a level of risk, I would say is medium. And I'm saying is medium because um, it might not be a deal closer for investors, but it will delay the process. So a very stringent, a very serious investor would say you need to put all those things in place before we proceed. We've seen that happen many times. So they will say, "Oh, while we love your product, we love what you're building, we've identified these things," because they won't give you money to go and clean up your mess. They
Definitely.
want everything to be done. Because when you are getting funding in your term sheet, but there is a clause called purpose of fund, right? So you will tell them what you are using the money for. And you won't just put it on paper. Most investors would require a periodic reporting, maybe monthly or quarterly. So you'll be giving them even active account statements, what you use the money to do. And
Yeah.
the smart thing most investors would now do is that they will release the money in tranches, right? So if they gave you the first tranche and you in your reporting you are now reporting, oh, we use the money to clear some regulatory fines, trust me,
Hmm.
there will be one hidden clause
Uh,
there that says that's a material breach. You will return
mhm.
that money back. So things like these are very important. While it's not a high risk, it is a medium risk. It's something that can delay the investment process. So yeah, it's still very important you have it in place.
Okay, so I don't know whether you have any addition to this, Caleb.
Okay, just in addition to it, like you mentioned, the question was how critical it is, data protection compliance it is for US and EU investors. So in recent times, you would have come across headlines whereby companies are being fined. Like recently, Nigeria, I think it's in Nigeria, they are looking into TEMO, right, for data protection violations, right?
Mm.
Some other countries too are looking into TEMO to see how they're processing data. And just as that last year or last 2 years, I think, I mean, we heard about the $220 million fine by, the FCCBC
Meta.
to Meta, right? So that's to show you that data is gold in this digital economy, right? And how it's being processed, it matters, right? And now we are even seeing the discussions around AI and data processing, personal information and whatnot. So it is very key. So as a company or as a business, right, and you are handling the data of your customers, it is important that you are very compliant because the risk involved in that is regulatory fines. If it is discovered that over time you are not complying with the data protection laws of your country to start with, how then can they guarantee or gain confidence that you be data compliance when it comes to the international space like GDPR, like in the UK, in the EU, right? The General Data Protection Regulation, right? For instance, in the US, if you're going to process international data. So they need to make sure the investors need to see that confidence that okay, your data processing structures are in place, right? And the basic of them all is your privacy policy. Your privacy policy should be prepared in a way that it is considering international expansion, if I might add, right? If your privacy policy, because the privacy when I prepare privacy policy for my clients, right? Try to make sure that I consider international data protection laws, right? So if they are going through your privacy policy and they say, okay, this privacy policy is already considering the international customer base, whereas they are still at the local level. Okay, that can boost okay, these people know what they're actually up to. If they see like you have data processing agreements, let's say you have subcontractors
Mm.
who you are dealing with, definitely you might need to share certain information of your clients, of your customer base with them. So if you are doing any transaction, you're working with, let's say, subcontractors to handle certain kind of, let's say, like payment processing or whatever service they're going to render you that requires customer data. If they see that there are data processing agreements with these subcontractors, right? It's to ensure or boost their confidence that okay, they are trying to make sure that they are covered on all grounds. Because if there is no data processing agreement with subcontractors, means they are not bound to comply with any agreement with you. They can decide to do with your customers data what they will, because nothing specified the limits to which they can operate with the customer data you give them. So if all these things are set in place, I believe the investors' confidence can be well aligned and boosted. So yeah, so make sure that your security measures are tied back end. Making sure that like cyber security, make sure that your firewalls are not easily penetrable by let's say hackers to get the information of um your customer base. You have the necessary officials like the data processing officer, just as mandated by the NDPC, right? Another documentation and policies that need to be set in place, and you are good to go.
Okay, thank you very much, Caleb, for that addition. So we are rounding up now. What is your parting thoughts? What's your advice for startup founders here? Oladimeji, let's start with you.
Oh well. So what I would say is, so compliance is not something you want to leave for later, right? Um, See, global seed capital, investors, they don't reward ambition alone, right? They don't reward the passion. They reward the structure that you have in place. And compliance is not about impressing, the regulators, right? It's about building trust, because that's really what it is. Because when you lack this all this compliance structure, as myself and Caleb mentioned from the very beginning, it creates uncertainty. And when there is that, because believe me, the African market is volatile enough, right? So you really want to convince the investors that when we receive your money, don't worry, we would use it for the business, right? So you just want to take away compliance, take away that fear, that doubt that, oh, something, this investment will not go well. So internally, make sure you are aligned, protect your equity, secure your intellectual property, and establish that governance. And externally, ensure you've demonstrated all the regulatory um, awareness, requirement, everything you need to put in place, to ensure your operation go well. And just ensure you have those structure in place, they are clear enough, and everything is right. That way, it gives the investors the confidence, to work with you and invest in the company. This is pretty much that's it. Thank you.
Yeah, thank you very much, Oladimeji. So over to you, Mr. Caleb.
Okay, so yeah, I mean, Mr. Ladimiji has pretty much said in summary what needs to be said. But I would like to add to that what you are seeking from investors is money, right? And the amount of money that you end up getting will be based on the risk exposure your compliance setup has. If your risk exposure is high, expect little or nothing, or less than nothing, right? So let's say, for instance, you were supposed to get, let's say, $100 million investment, and your risk exposure is high. If it is something that can be remedied, they won't give you that 100 million because you know that, oh, certain amount of money you will use to rectify those internal inconsistencies, right? So because valuing, what they are valuing is your structure, what it takes to run your business. So if there is execution risk and legal uncertainty in your startup, right? That may dissuade them from giving you more than you anticipated. Because if the risk is high, the money will be less. Because those companies, they're also out there to make money. VCs are also businesses, in case some people don't understand, right? These venture capitalist companies, they are out there to make money, even if their returns may be spread, in a serious period of time. They might give you 20 years or 15 years, but that money that they are putting in, they must make it. So
Because it's not even their money.
ahead of you get, it's never their money. I've worked in a finance company before. I've been in the finance industry, so I know how money comes in, right? Even the finance company I worked in at the time, right? They were even seeking to gain more money to be able to do their business and invest in
Yeah,
certain
yeah.
things, right? So you are working with investors' money. The VC company are also working with their investors' money.
There's no money.
You get, so the moment you understand that what this is a business, but they are not dashing you money, they are not giving you money. They are giving you money to be able to reproduce that money and give it back to them. And the earlier you understand that, the better you approach the business, right? You understand that, okay, this, because some people don't understand that venture capitalist money is easy to get to if you do the right things. But when you now fail to do the right things after getting it, you will have sleepless nights because you'll be thinking of a way to get the money back to them. Right. So once you ensure that your structure is in place, right, your compliance is up to date, your structures are well balanced, everything, every documentation is key. If I would leave, if there's anything I'll leave, documentation is key. Every contract you enter into, any service you gain from anybody must be well documented. And like Mr. Ladimeji rightly said, protect your IP. Your business started as an idea. and it will keep running on ideas that come up, across the year. So the moment you keep protecting those ideas, and making sure they're well protected, you see, you'll be able to make sure that you close faster, deals faster. Because whatever, if imagine every a company that has all their documentation in place, it might take them 4, 6, 8 weeks, 12 weeks to even close. But when you are now trying to regularize, what should have taken 8 to 12 weeks will now take 3 to 6 months. And you discover that in most cases, within those 3 to 6 months, the investor might now lose confidence and pull out. They will pull out and it's gone. You now have to start afresh. So it's important that every single documentation that needs to be present to boost the confidence of the investors, every single regulatory compliance. If there are officers you need to hire, make sure they are in place. If there are documentation that needs to be done, make sure it's done. If there are registrations that needs to be done, make sure it's done. You make sure your books are in order. Another thing too, if I might add, is tax compliance, right? Some companies, some founders may be oblivious to tax. Like recently, I was speaking with one of my clients, and we were talking about, because now there's a new tax law in Nigeria that I was speaking as regarding to tax compliance. And I was like telling him that, see, in Nigeria, most businesses, let me use the word businesses, they are oblivious to the fact that they have to pay tax, right? So imagine you've been running your business for like 5 years and you've not been tax compliant for the past 5 years, and you now discover that when you now want to comply, the burden is now heavier. Or let's say you now need investors, the body will not become heavier. But once all those things are taken care of from the get go, I think it will make a whole lot of things easier for you. So just make sure that your documentation is in place, your structure is well organized, and with that, you can easily get the global sales funding you're looking for.
Yeah.
Thank you.
Let me add. So the consequence of a delay, right? Now, this is from a venture capital perspective. Let me tell you the process flow. When you submit your pitch deck, there are analysts that will review all these things. They would now send it to maybe the senior analyst. So these deals they are filtered, right? So once
Yeah.
it's filtered, they can take we can have when I was in the VC firm, we can have like 50 offers, right, in a month. So when we filter maybe 10, 20. So the 10, 20 will go to the first stage where we can have the first call. Oh yeah, now you can now speak to your pitch. Let's see what you're doing. Then we go to maybe the due diligence stage now. So now during that due diligence stage, that's where all those red flags are identified. You see, the consequence of delays when you don't have all those compliance and all those regulatory things in place, both your internal or external compliance, is the venture capital space is fast paced, right? The people that would decide if the deal would move forward, they don't have time. So they are called the
Hmm.
investment committees. They
Yeah.
can meet they can meet maybe once in a quarter or once in maybe by
Biannually.
monthly, right? So imagine you're while in the process where you are still trying to regularize, the investment committee at their meeting, they would make the
Yeah.
decisions on who is on
And you'll
ground.
be left behind.
And you that these guys, oh, they are still fixing their books, blah blah blah. The decision has already been made. And by the
Hmm.
time you are ready, the money is no longer available. It has
It
moved.
has been channeled somewhere
So
now. Yes.
it has been channeled to another startup. So that's the consequence. So things like these are something you need to prioritize and do immediately, because while you are trying to put things in place, someone else has collected your money, even when you are the good
Hmm.
product.
Yes, very true. Very true. You're not the only one that is seeking funding. You're
Ah,
not the only one that is seeking funding. So,
Yeah. So it's been an interesting session. Thank you very much, Oladimeji and Caleb, for making our
yeah.
time to share the insights and knowledge shared with founders here. And thank you, everyone. Thank you, founders, for joining out this session and for learning. So if you have more questions, I can see a couple of people sending in questions. You can ask your question on the WhatsApp group, and we will take it up from there. But then, if you need the speakers for the Delaware registration and every other thing, you can reach out to them on social media, specifically on LinkedIn. They are very active. You can send them a message on LinkedIn concerning the Delaware registration and all of those things. So once again, thank you very much, Caleb and Oladimeji, for taking our time out of the busy schedule
It's a
to make
pleasure.
sure that this conversation is had. Thank you, everyone, and do enjoy the rest of the week. Thank you, and bye bye.
All right. Thank you for having me. It's a pleasure.
All right, thank you.
Bye.
Bye.
All right.
All
Bye,
right, bye,
everyone.
Caleb.
Bye, Mr. Lidwin.